Now let's talk about SPACs, or special purpose acquisition companies. Let's explain them first and explain how they work before we talk about the regulation, because it's very, very important that you understand the purpose of a SPAC and why it's created. A SPAC is a company. Think of it as a shell company. Shell company means a company with no operations. So it's just a company on license. So it just has a license, a trade license. That's it. Doesn't have any operations whatsoever. And this shell company gets listed on the stock exchange. Let's say they get listed on the New York Stock Exchange. Now, they have no operations. How do they even manage to raise capital? I mean, who is this investor who's going to put money in a company, in a shell company that has no operations? It's only a trade license on paper. Why would an investor do that? Why would an investor invest his money in a company that doesn't do anything? Has no operations, no products, no business? The reason is these SPACs, these shell companies, they are created for one purpose. And that purpose is to merge with a new growing company. An example of this is, well, there are lots of examples, but for us here in the Middle East, you've got Anghami. Anghami is like Spotify. They're a music app. They're based out of Beirut, and they have grown and they wanted to get listed. But getting listed on an exchange is a lot of work, high costs, a lot of paperwork, lots of protocols and procedures. So what Anghami did is they looked for a SPAC that is already listed on the exchange, and Anghami merged with them. And when they merged with them, Anghami became listed. So SPACs are created for one thing, and that is find companies who want to get listed, but they don't want to go through the whole procedure. So they would just merge with them. So you can see now why these investors are interested in SPACs. Why an investor would invest in SPAC is because this SPAC, this company, this shell company, might in the future find a company to merge with and take it on the exchange. And this will bring growth in the share price. So SPACs are created without any operations, with one purpose only: to help private companies get listed by merging with them. And that's it. So any investor who puts money in a SPAC is putting money in a company that doesn't do anything yet. And that's why we call it blank check company. It's because this investor is giving them cash for nothing in return. He's giving them a blank check. Why? Well, we hope this SPAC might merge with another company in the future. Well, that's a lot of hope. That's a lot of risk you're taking. So this is SPAC. So let's go through this quickly. So a SPAC is a special purpose acquisition company, alternatively referred to as a blank check company, because investors are given it cash with no operations and no products, with no assets whatsoever. It's just a paper trade license. It is formed with the sole purpose of effecting a merger to raise money through an IPO. So the SPAC raises money through an IPO here so that it can buy another company or merge with it. So the money that the investors give it, the SPAC will take that money and then buy Anghami and merge with it. So basically, they buy the shares of Anghami and then merge the two companies. Anghami gets listed, and the investors that invested in the SPAC now own Anghami. At the IPO stage, which is the first stage here, SPACs do not have business operations. or stated targets for acquisition. They don't even know what company they're going to merge with. It's actually one of the requirements from ESCA and the regulators is that when you are creating a SPAC and raising capital, you should not already have a target company to merge with. No, 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 no. When you are creating a SPAC, you should start fresh. You cannot create a SPAC saying, in 3 months, I'm going to merge with Anghami. No, no. They won't give you, they won't allow you to create a SPAC. So SPACs should not have any business operations, and they should not have already stated their target of acquisition and merger. Subsequently, an existing operating company like Anghami can merge with or be acquired by the SPAC. And in that way, when these two companies are merged, Anghami becomes a listed company. They get listed without having to go through the whole IPO themselves. The SPAC essentially removes the need for the operating company to execute its own IPO. Sponsors set up the SPAC. Sponsors are the people who create the SPAC. So when the SPAC is created, you've got the sponsors, sort of the founders of a fund. You've got the sponsors and you've got the investors. So the sponsors, they set up the SPAC and invest enough cash to cover the initial operating expenses. In return for the investment, the sponsors get something called the founder shares, which will often be around 20% of the SPAC. You will see as we move on in this chapter is that ESCA says it should be between 3% to 20%. Not less than 3, not more than 20. These sponsors will typically bring together a credible and experienced board of directors for the SPAC, and the team assembled by the sponsors will raise the capital from the investors. Because investors, if they're going to invest in a SPAC, you need a team, you need a management to go and do the roadshow and attract investors and then offer them these shares. And also an investor is going to invest in a SPAC. They need to know that the people running the SPAC, they are able to execute a merger properly. The capital raised is usually in the form of shares with warrants. Remember, I don't know if you've done other CISI qualifications, a share with a warrant means a warrant, we know what a share is. A warrant is an options contract that allows you to buy shares in the future at a certain price. So it tells you, okay, look, you know what? We will give you a warrant, allowing you to buy our share of the SPAC at $10 in 3 years. The investor would say, in 3 years, I think the share price is going to be $50. Well, if I take the warrant now, then I'm going to be able to buy it at 10 because that price is locked. I'll be able to buy it at 10. So that's a good deal for me. I'll take the warrant, and warrant allows you to cancel. If you don't want it in the future, you can cancel. Yes, there is a small payment you make, but you can cancel a warrant if you don't like the price. The warrants typically enable further shares to be purchased at a small premium, small fee, to the share IPO price. They are a call option. SPACs have a limited lifespan. Usually 2 years. That means from the day you get listed as a SPAC, your regulator gives you 2 years to merge with the company. If you are unable to merge, if you are unable to find a company to merge with, that SPAC should be shut down and the capital should be returned to the investors. And this is the case. This typically 2 years time frame is usually the case across the world, not just in the UAE. I don't think we have here SPACs in the UAE, but they are very, very popular on the New York Stock Exchange, in America. And yes, the regulator in America, the SEC, gives SPACs in America 2 years to find a company to merge with, or else that amount needs to be returned to the investors. Good. You see, we've taken our time to explain what a SPAC is. We've gone through every word and every sentence because I'm pretty sure for many of you, the concept or the idea of a SPAC is new. So now that we understand what a SPAC is, let's look at the regulations for SPAC. So ESCA says a SPAC is prohibited from practicing any activity. Remember, a SPAC is only a trade license. It's a shell company with no business. It's banned. It's prohibited from doing any business operations. except for the following: offer, issue, or list its shares. It can do an IPO. Well, yeah, that's its main function. Search for a target to acquire or merge. Again, that's what it was created for. Or other business related to achieving these two objectives. Now, to be classified as a SPAC, the founders must apply to ESCA on the required form, obviously. ESCA will then either accept the application and grant the classification or reject it. For acceptance, the following conditions must be met. One, the issued capital must be at least 100 million dirhams. For SPACs, please memorize these numbers. Two, the founders must not have announced or disclosed any acquisition target or potential acquisition targets to any person other than the sponsors. In many regulations, you're not supposed to have any acquisition targets. ESCA is saying here you cannot announce or disclose it to anybody other than the sponsors. So you might be allowed to have a certain target in your mind, according to ESCA here, but that target must not be disclosed to any person other than the sponsors. Companies classified as SPACs are exempt from many provisions of the company's law, including the need to invite the public to subscription. They don't need to do the subscription. They need to appoint an underwriter, because usually when companies are issuing stocks, they usually appoint an underwriter to help them raise the capital. Priority rights to subscribe for new shares. They don't need to have rights issues. They don't need to have any restrictions on trading the founders' shares. So usually, founders, when they list their companies on the exchange, they need to wait like 6 months before they can sell the shares. That's not the case with SPACs.